sponsored by the Securities and Exchange Commission of Nigeria.
Welcome back to our program. Now, the federal government bond prices in Nigeria are up between 15 and 20% this year. Not bad in the context of the global low-yield environment. But where are they likely to head for the rest of this year? And what are the structural changes that are likely to underpin the performance of the market this year? We find out more.
The most important factor in interest rates is monetary policy. But now, the second most important factor is the activity of offshore investors in Nigeria. Because the amount of funds that they can bring into the market at any point in time can change the entire complexion of that particular market. So if we see what happened in 2008, where there was a global crisis, all the money went out at one point in time over a short period of time, then it has a significant impact on prices.
The depth and liquidity of the secondary bond markets remains relatively attractive. Bond and treasury bills constitute the most liquid securities market in Nigeria, greater depth than the equity markets, for instance. So for institutional investors who have large funds to deploy and significant positions to take, it makes sense to invest in bonds, sovereign bonds and treasury bills because of the scale and the liquidity factor. So we think that will continue to be the case. As long as the government's fiscal plans continue to be congruent with their monetary policy plans, the fundamentals should dictate that government debt remains attractive. And as we develop the OTC market, the FMDQ market, and more state and corporate issuers come to the market, we also think there will be more interest in the subnational space as well.
That's a question that we always ask ourselves at Standard Chartered, right? When is this going to reverse? Could there be a reverse in the flows that we're seeing here? The last time we saw a reverse was in 2008, December, again prior to the crisis. There was a global crisis. Everybody was taking off the money from frontier markets. So we ask ourselves, could that happen again? But I think for an offshore investor, what he's asking himself is, if I take my money out of Africa, where am I going to put it? Yields are very low in Europe, very low in Asia. Where else will I get value? So I've been sure if things remain relatively constant, and though I still expect flows into Nigeria, into Africa, into Ghana. So I think we're going to see sustained flows. When we're included in the JP Morgan index, we saw a wave of money coming in. I don't expect to see a wave of money coming in going forward. We'll see trickles coming in from time to time, sustained trickles. And again, the other thing we're seeing is that apart from the portfolio short-term investors, increasingly we're seeing people that are willing to invest for longer term. So it could be a pension fund, it could be a real money market fund in Europe, or an asset manager that has a more long-term view of Nigeria. The other thing we're going to start seeing is what you see is people first going to the capital, which is basically stock markets and bond markets first. As this gets sustained, you now start seeing real investment flows into the real sector. So people investing in Nigerian companies, right? People investing in Nigerian infrastructure. That's where we'll really start seeing the benefits of the offshore flows.
The inclusion of the Nigerian bonds into the various indices helps because it guarantees a certain level of consistent buying and positioning in Nigerian securities. And also the fundamental macroeconomic indices that are positive for Nigeria at this moment also help. Of course, if you see one or two things change, like oil prices drop off, then the interest might wane or reverse. But fundamentally, compared to 2012, we expect to see sustained foreign interest in Nigerian securities. And compared to, say, 2010, 2011, 2009, we expect to see significant uptick in the interest. So we think that will continue to be the case. Nigeria is now an important frontier market and is on the road to really transiting from being a frontier market to an emerging market.
And while the prospect of an easing in monetary policy in 2013 and sustained foreign interest in Nigerian sovereign debt is expected to underpin what should be another good year for federal government bonds, there's a strong case for the issuance of state government bonds in the new year.
In terms of, state bonds is a slightly different scenario from corporate bonds. If you look at the state government budgets that are being proposed to the different state House of Assemblies, clearly when you see the size of those budgets, there's just no way they can be achieved without significant borrowings. even from the rich oil producing states, they have huge deficits between their revenues from various sources and the amount that they want to spend. So they have to borrow. The question is, do they borrow from banks or from the bond markets? Given the fact that right now, in terms of pricing, the bond market is the cheapest place to raise long-term funds, I would expect a number of states who haven't hit the market to come to the market next year. The option of going with bank loans is very good on the very short term, but if you're a state government trying to do long-term investments or long-term development, it's very tricky to go on a floating rate loan that could reprice at any time to a level that you will find difficult to sustain.
The prospects, however, for state government and corporate bonds is less certain. Problems with the market structure make these bonds less liquid than federal government bonds.
Issue sizes are not very deep. So typically, the corporate bonds out there and the state bonds out there issue 20 or 30 billion a time. That doesn't leave enough trading stock or float for the secondary market to trade. So, and the buyers tend to be buy and hold people, pension funds, institutional investors. So between those two things, there's not much liquidity to trade. Structurally also, there are issues with the secondary market trading of state bonds and corporate bonds, specifically the lack of SEC-approved over-the-counter platform for these securities to trade.
The Securities and Exchange Commission recognizes the importance of the subnational and corporate bond market and is making the necessary changes to the structure of the secondary market to enable these securities thrive.
We also, last month, approved the Financial Market Dealers platform, which was an over-the-counter platform which will provide more transparent trading on bonds. And we will, probably before the end of this year, and if not so early next year, also approve the National Association of Securities Dealers platform. So there are 3 different platforms that potentially you can trade bonds on. So we expect greater liquidity.
For Nigeria's bond markets to make the next step in its emergence as a destination for foreign capital, market watchers point to other market structure changes and the need to deepen the pool of products available.
Firstly, product development is very important, specifically securities lending and a repo framework that works. Better liquidity in the repo market and a proper securities lending framework that is actually backed by the regulator and allows that liquidity to be provided into the market. Essentially, markets should be able to position both ways, long or short, depending on the direction of interest rates, and the securities lending or repo framework will enable that. And we're working with the central bank and the debt management office to put this in place, and it's very imperative from a product development perspective, especially as the country opens up to international investors. Then the other piece of it is also getting the primary dealer system on the government bonds working better, especially in terms of how the risk and rewards are aligned. And primary dealers are currently mandated to make a market in government securities. They should be rewarded accordingly and incentivized to do so. Once that alignment is there, you'll find that secondary market liquidity will pick up and the market will deepen and continue to develop.
If you look at the bond market, a lot of activity is bank to bank, bank to pension fund activity. What we need to see is a creation of real demand for fixed income instruments. So again, more pension funds, more asset managers, more individuals, more companies. So there's real demand and supply is already there. As you see more real retail institutional demand, right, it creates more natural liquidity for the market. So what you don't want is a situation where the primary dealers simply buy securities and sit on them and they carry all the risk and the benefits. What you want is a situation where real demand, i.e. institutions, private investors, offshore investors, insurance companies, increase activity in the market. That's what's really going to drive an explosion in the growth of the bond market, increase liquidity, and make it really meaningful for all sectors of the economy.
As part of moves to increase retail participation in the bond market, the Nigerian Stock Exchange is currently in the process of reorganizing the broker community to better accommodate retail investors.
When you go to the banks, you find out that they can actually sell you a bond-backed instrument. Now, why they do that is because there is no framework for the transfer of retail. So you as an individual can go to the bank and say, look, I want a secured instrument, maybe federal government type. Say, well, sorry, we can't break it down and give it to you, but we'll give you a paper based on that. We want to involve those people that want to participate directly in government bonds, in AMCON bonds, in all types of bonds that are on a retail basis, so that they can get the benefit without having to reduce their commissions, or, because banks will definitely add their own premium on whatever they're selling to you. So we're trying to get you involved directly into it, so that the person on the street can buy the bonds and trade them anytime he wants to and get the benefits. There's a chunk of OTC trade going on within federal government bonds, state government bonds, that's not captured within the stock market, and we felt there's an opportunity for such developmental products to be made within the stock exchange. So we have looked at it and decided that we are going to launch a fixed income money market system within the Nigerian Stock Exchange. And the whole idea is to capture the OTC market. We understand that FMDA is doing their own wholesale type initiative, but the retail side is what we want to capture within the market, and efforts are being made to actually do that. We want a situation where brokers can quote two-way, both buy and sell, so that they quote what they are willing to buy and they quote what they are willing to sell on securities that they are appointed market makers for. And the essence of that is to actually create some kind of activity within the bond market. So you have a liquidity provider, you have the market maker, and within the context of all of that, we're likely to see a huge development in terms of increase in amount of trades done. The DMO has already appointed a market maker for their own bonds, which will be traded on the stock exchange. I understand AMCON is also trying to appoint their own market makers who would provide liquidity for them for their own bonds. As you know, AMCON bond is not being traded. Federal government bonds on the OTC side is hardly being traded. So we want to generate that particular capacity. And AMCON is probably the biggest single issuer of bonds outside the federal government. And so they probably will require some kind of liquidity provider as well as a market maker. I don't know whether they are going to appoint one or two, but it's up to them to decide what they're going to do. Project plan shows that we want to launch this December. However, if there are any delays, it won't pass January.
But we think the creation of a retail window via the stock exchange is a good idea to bring retail investors into the bond market or the fixed income market. The creation of bond funds, mutual funds that have a fixed income component is also a very important element of that. So people can access fixed income risk on a retail basis. And we think what NSA is trying to do really complements what we are doing on the wholesale side. And we think there's every chance that they will succeed, and we wish that to be the case, because it only strengthens awareness about the bond market and the depth of the market.
This is not the first market it's happened. You hear of national saving bonds in the UAE or in America. Savings bonds are largely bought by individuals. And again, even if you look at where we are in the cycle, interest rates or yields on Nigerian bonds are actually pretty attractive, right? Especially earlier in the year. They have come off this year, but earlier in the year they're very attractive. So it is an avenue where I see value for individuals. This year, more than any other year, we've seen individuals move away from just simply keeping their money in banks to actually investing in securities. Most of the activity has been on the short end with treasury bills, again because value has been so good there. But that education of the general populace is taking place or has taken place, and that's why you've seen that shift towards let's put our money in securities, yields are good, it's zero risk, we're lending to the federal government. Increasingly, what you will see going forward is people now start saying, this market does make sense. I can put money away here, and guess what? I can get income to repay my children's school fees. Every 6 months, I'll get a coupon payment, which could be like a dividend payment. I can use that to structure my children's school fees, to structure my savings. So I think that education has taken place. It will continue. And you will see increasingly individuals looking to invest in the bond markets, in fixed income markets, because there's value there.
On top of the initiatives driven by the stock exchange, specialized bonds linked to various infrastructure projects are also in the works. The National Pensions Commission has approved infrastructure bonds as an eligible asset for pension fund investments, and while progress may be slow in making these products available to investors, they remain an important part of the development of Nigeria's bond market.
Well, I mean, infrastructure bonds are bonds that are issued on the back of existing infrastructure. The challenge in Nigeria is that you really don't have a significant pool of privately owned infrastructure that has a predictable future revenue stream. Without the underlying assets, you cannot issue the bonds. If you look at recent draft PENCOM guidelines for PFAs, they have huge allocation that could go to infrastructure bonds, north of 20% of their portfolios. But, I mean, who exactly will issue these bonds? Most likely suspects are the power companies, but those haven't even gone private yet. The privatization process hasn't closed. And so until you have very credible sponsors who are in a position to actually issue bonds that the market can very properly assess the level of risk, that might not happen immediately. It's difficult to see anyone closing next year. It could start, but actually closing, given the requirements you need for credit quality, credit enhancement, or proof of cash flow, I'm just not sure which private assets in Nigeria meet that requirement apart from the ports.
And that's our show on Eye on Nigeria's capital market for this month. It's still fingers crossed as to where Nigeria's bonds are likely to go next year, but certainly I hope you've learned a thing or two about how attractive they look, especially in a global context.